Hey everyone, welcome back to the channel. Today we're going to be looking into one of the most important trading concepts that you need to understand before attempting to trade, and that is liquidity sweeps. If you've ever taken a perfect trade that moved in the right direction only to get stopped out before it takes off, congratulations, you witnessed one of the most annoying things in trading, which is the liquidity sweep in action. And by the end of this video, you'll understand exactly why that happens, how to identify liquidity sweeps, and also how to use these liquidity sweeps to your advantage in your own strategy. So before we talk about what the sweeps are and what fakeouts are, we need to understand the concept of liquidity itself. And liquidity is simply where pending orders sit in the market. Think stop losses, buy stops, sell stops. These orders are fuel for price movement. The market needs liquidity to move. It's like a car needing fuel to drive. Now, here's the key part that a lot of traders overlook. So liquidity builds up above the highs and below the lows. So what I usually do is I go to the 1 hour chart. This is probably one of the best ways to actually look at it and look at where all the price is building up. So the highs of the hourly candles are around this range right here, the 4275. And then you've got the lows that are around this range for 4,200. I'm looking on gold at the moment. This is just the example that we're going to be doing it on. Now, above these level of highs, you'll usually find clusters of buy stops. And below all the lows, you'll usually see a lot of sell stops. And guess where big institutions love to take price before meal move? Into these pools of liquidity, this range on this range. So basically, all you need to understand, I'll play a quick clip right now. And on this video, what it will show you is exactly what these big institutions and banks do to try and get people out of the stop losses before making the real move. And the whole reason behind doing this is because they take more of the liquidity for themselves. If they can push, so let's say this is going for a buy right now. Gold is going to go to a buy, and you believe it's going to go up for these higher highs that it did on Friday at 4,380. Let's say New York market opens and you believe it is going to go up here. But then when the price is taken down this way suddenly, a lot of people who are just not familiar with it will think, oh, well, it's a sell then. But what is actually happening is these banks, institutions, and massive hedge funds place a lot of orders to then push the market down in the opposite direction. Because then what they can do is once the liquidity sweeps are all done, usually there's 1, 2, 3, maybe. There could be multiple fake outs in one session. And all they're trying to do is push the price down so they get a better entry when the price actually goes up. So they're making more money from the trade, and also at the same time, they're taking your liquidity to then make themselves more money. So that is liquidity sweeps. A liquidity sweep happens when price intentionally moves above a previous high or below a previous low to trigger those pending orders, just only to reverse right after. I find, especially if you're doing like the opening of New York session, sometimes there'll be 1 or 2 or 3 before it actually moves in the right direction. And this is why trading can be so hard for people who don't understand this concept, is they'll get stopped out so many times. And this happens to so many traders, even the traders who are making 100 grand per trade, they will still fall victim to these liquidity sweeps. So identifying them can be a challenge sometimes, but this video is going to help you minimize you being stopped out as much as possible. So let's say gold is trending upwards. You see a clear resistance level at this 4273 region, and it finally breaks this. It breaks past this level of price. It breaks past 4275 and looks like it's going to go all the way up to 4,380. You're absolutely buzzing because this could move upwards for $100. Then suddenly you get to about here and the price reverses, stops you out, and then continues to go lower. Usually, a lot of times, 9 times out of 10, it's the liquidity. So I've just went down to the 5-minute chart just to show you an example of what happened to myself on Friday. So New York market opens around 1:30 this time. It opened around this time here. And as you can see right here, there was multiple times where the price dropped even further down below, goes up, drops down, goes up, drops down. These little red candles right here, those are the liquidity sweeps. Obviously, we're looking at a 5-minute chart, so it's harder to see when you'd be looking on the 1-minute chart. So we'll go on to the 1-minute chart just to show you how bad these liquidity sweeps can actually get. So at 1:30, the market opened. Now you can see quite a few times it's tried to go above, go for a buy, and come crashing back down to this level right here. Now at half past directly, this is the first liquidity sweep that happens. As you can see, it looks like it's going upwards in a trending direction, but it goes up, goes slightly down. You can see that 1 minute candle there that goes down all the way. That will stop you out. That is a small little liquidity sweep, especially if you had a small stop loss on. Let's say you entered around here and the price comes crashing down there. The same here. Let's say you entered 4246 and the price comes crashing down to 4230. What they're trying to do there is they're just trying to take as many orders out as possible, get a bit of a lower entry for themselves. So when they do go for this buy trade right here, they make even more money. That difference in $10, especially with these market makers, because you've got to think about these market makers. They are giant traders that are just trying to fill massive orders. They can't just hit buy or sell like we do. They need other traders on the opposite side. So to fill their big buy orders, they need people willing to sell. So price gets pushed lower first. Those stop losses trigger, creating sell orders, and the institutions quietly buy from them. Then boom, the market reverses upwards. The same logic applies for shorts as well. So price moves above a key high, triggers all the breakout buys, fills institutional sales orders, and then dumps. So where do you actually look to find these setups? You'll actually want to mark out 3 main types of liquidity zones. And you want to do the session highs and lows. These form around the Asian, London, and New York sessions. And basically, when a new session opens, like what we were just looking at, then the New York market session open for Friday, fresh money enters the market. A lot of new liquidity enters the market. And it often seeks to sweep out the previous session's liquidity before making the real move. Now, if you look down here, this was the previous day's session. The lowest points were down here at 4,221. This is when New York market opened. It went to the lowest point of 4,221, then went upwards slightly to around 4,260. Then it came crashing back down to then get the previous session low of the London session down here, and then came down to get the Asian low from the previous day down here as well. And on Friday, usually there's a retracement. So it'll come down to get these levels of liquidity from the previous days. And on Friday, usually retraces up to the weekly high. So that's what I was actually looking for on Friday. Was thinking, oh, it's going to go even up, just wait for these liquidity sweeps, and then it'll go up. What I actually did do is use the New York morning session to come get that previous level of liquidity from the Thursday Asian session, which was the lowest low down here. So as soon as it got that, then in the afternoon session for New York, that's when it started to retrace upwards to sort of try and target high highs, previous sessions. So marking out these session highs and lows, that's what will help you figure out where the markets are trying to move to. They're trying to get those levels of liquidity first before pushing it in the right direction that you're actually seeing. So when price marks 2 high highs or 2 low lows in around the same level, that's a magnet for liquidity. So this low right here, where the price has been on the Wednesday session and the Friday session, this high right here where it's been once and come back, hit this high again. So these are massive levels of liquidity. And usually what happens is there's tons of stop orders stacked above or below these points, making them perfect targets for sweep. So that's what the banks will be looking for. They're either trying to take out the session lows or the session highs before moving in that right direction. The next one you need to be looking out for is trend line liquidity. So you can see that I've just put this trend line on the graph just to show you exactly what you need to be looking for. And this is on the hourly chart. So you can see that gold is in a massive uptrend, and you want to just be trying to mark out the lows for each of these sessions. So whenever the price comes around this trend line as well, that's where there's going to be a lot of stop orders sitting right underneath or above this line. So the moment it breaks this trend line, those stops trigger. So right now, what it looks like gold is about to do on the hourly chart, looks like it's going to come down to try and get the lows of this session, like around here, this sort of level of price, this higher high right here. It'll come down to around here, most likely. And this is going to be what they're trying to do, is they're just trying to get all of the liquidity before moving it upwards in the right direction of the trend. And when you use the trend line, you can start to sort of see what they're looking for, especially when you look on the hourly chart. It looks like it's about to do this, bounce off the trend line, take out everyone's stops, and then come up. So the example I showed you before was an uptrend sweep. So Friday's example is a perfect example of a downtrend sweep. The price is making those lower lows and lower highs. Then you see a clean support level, which you believe probably will be this higher high breaker structure level right here. and the price pushes below that, everyone stops generating sell orders. Then institutions use those sell orders to fill their buys, and the price reverses upwards. And this is not trend sweep what happened on the Thursdays or Asian session or something like that. Come up for that higher highs, come down again, went up, looking like it was about to break those higher highs and go even further, not managing to break it, taking the liquidity and then going downwards. Trading, the role of trading sessions is completely important, and understanding timing is just as important as recognizing the structure of everything. So each session, you've got the Asian, London, and New York session introduces new volume and new traders. When London opens, for example, so around the time that I've woke up UK time, the price often sweeps the Asian range before setting its trend for the day. So in the Asian time zone of last night, the highest it went up for was this level, 4,270 odd. The price comes crashing down just before the New York market open, and then the New York market open comes back above to then go for that liquidity from the Asian session. Likewise, when New York market opens, it might take out London highs or lows before moving strongly in the opposite direction. So in the London morning session, it was in a massive downtrend on the Friday. The highest probability sweeps happen at the session opens, London or New York. And it happened when they target a major high or major low. So for this one, they were targeting a major low, which was this section around here, before pushing the price upwards. And it usually happens when you see a clear breaker structure after the sweep. So obviously we're looking on the 1 hour chart. You probably want to be minimizing this to 1 minute when you're looking for your entries. But just to sort of show you an example on a longer, higher time frame, you can see that the lowest point went to was this range right here, then come back up. This section was a breaker structure. So it stopped going in a downward pattern and broke this level. As soon as it come back up above this level, obviously at the time, there was a little liquidity sweep that it did again here, which only took it to just on the line of the breaker structure. So again, that's what they were trying to do, is just take everyone out of the stop loss orders before moving the price upwards. So how do you trade this? I'm going to try and give you a simple approach. So on your 1 hour chart, what you want to be doing is marking out the liquidity zones in advance. So the low of the Friday session, so the New York afternoon section, was this high low down here. The high was up here. Then you got a bit more. Then the Asian low was down here. Then on the hourly chart, you're just marking the end of the wick for each one. So you want to wait for the price to sweep one of these key levels before entering it on the session opens. That's what you want to. This is when you want to drop to a lower time frame. So you want to look on the 5 minute first. So let's say you were targeting a buy in the New York market open. What you'd want to be doing is waiting to see if it tries and tests this level where it goes to the low. Then when you see a clear breaker structure, like if you're seeing it go in a very similar pattern to right here in the end of the Asian session right here, where it goes down to this level, couldn't break it, then goes upwards. But then what you want to do is go down to the 1 minute time frame again, just to try and get perfect entry. Because if you look on a 1 minute time frame, what happens here is you could have entered at this stage right here thinking, oh yeah, this is going to go up for a buy. Nope. Then tries to stop you out once more before going in the right direction. So it's always important to look at the 5 minute. But if I was trading this, what I would have done is waited to see if it didn't break that. Then I'm looking to see if it breaks one of these higher lows. And then once it breaks one of these higher lows and goes above this section, then I'll be looking for me buy. I don't know, I'm just trying to finish this video now. Common mistakes that people make with these liquidity sweeps and just trading in general is that entering too early. Don't sell just because a high got taken. You need to wait for the confirmation that it's broke that area price and going in an upward trend. Trading every sweep, not all sweeps lead to reversals. It could just be a sweep, go back upwards, and then go for another sweep. So, you just need to keep an eye out for it and wait for your confirmation. And ignoring session typing, ignoring the session time. I personally only really trade on a session open. I think that's the best method to do, especially if you're a beginner trader, because those are the best setups. You don't need to be over trading and looking for it at random times, because it might not even work well. And always confirm. And then for getting structure, always confirm with a breaker structure, like I was saying before, or a fair value gap entry setup. So fair value gap, I can do more videos on this, but if you see a candle break down a massive amount and just go down from this range. So if you see a candle that goes down a massive amount, what you need to do is look at the wick of the previous candle. So the end of the wick was there at 4232, and then the start of the new wick was 4230. Not a massive fair value gap, but when price comes back up to this range, it will fill those fair value gaps really quickly because there's not much resistance or support or anything in these levels. So that's a fair value gap from this point, from that wick to that wick, then from this wick down to this wick. That's also a fair value gap. Now, this is what happened in the London session of this morning, which was quite cool. So it did exactly what we were talking about in this video. It come back up for the previous session's high, and as soon as it did, it came crashing down from 4263 all the way down to 4247. That would have been a really nice trade. So let's put it all together and recap. Liquidity is where pending orders sit above highs and below lows. A liquidity sweep happens when price grabs those orders and then reverses. Exactly what we just seen in the London session right here. Come up for those highs, reverse down here. The best sweeps occur at session highs or lows, or equal highs and lows, or trend line breaks. You need to wait for confirmation, you break a structure and fair value gap before entering, and you need to target the next liquidity pool in the opposite direction. So that higher low of the Asian time zone is what it came down for really quickly. It takes a lot of practice to try and figure out exactly what they are and where they're going for, but this will help you understand the movement of fakeouts and why they're actually happening and the direction that they're trying to go to. They're trying to go to those session highs and lows. So once you have that in your head, it gives you a better idea of just waiting and being patient for those exact setups to come in. So thank you for watching this video. Hopefully that helped. Leave any comments that you have regarding any of these concepts down below. I'll do my best to get back to you and help you with anything that you'd like. Leave a like on the video and subscribe to us for more trading content.